Welcome, everybody. This is Geoff Dohrmann, Institutional Real Estate Inc. It must be June because I'm not wearing my bow tie. It's summertime. So looking down the list, I see a lot of old friends, both investors and consultants and investment managers. So thank you all for tuning in. This is our quarterly update on the ODCE Index. What we do is we're trying to get a little behind the numbers and try to understand what the drivers are that are really driving the investment results that everybody's benchmarking against. Welcome also to our private wealth advisors who are tuning in. Kind of a new thing to have a private market index like this available to you. But the more you learn about it, the more you're going to see that this really is going to be a useful tool for benchmarking the recommendations that you're making to your clients, benchmarking the performance of their portfolios. And, I'm convinced that the future of capital funding for real estate and other private market alternatives is going to continue to be the private wealth market. So it's really important, and we're really grateful that you're starting to tune in and take a look. At any rate, here's how it's going to work. We are recording this, and those of you who want to see it, spend a little more time, or share it with other people in your company, will be receiving in a week a copy of the recording. And you'll also be receiving a copy of the slides that Garrett Zdolshek is going to be presenting. So you don't have to take and scribble and do a lot of notes. You're going to get both. And so you can really pay attention. Now, during the presentation, we encourage people to submit questions. And the way you do that is down at the bottom of your screen, you can see little icons, and one of them says Q&A. You just click on that, and there's two ways you can submit. One is to submit with your name. And if you do that, I'll announce you as the person asking the question. And if you prefer to do it anonymously, you just tap anonymous and then ask your question. So I really encourage you to get involved and engaged. Garrett is really good at fielding and answering your questions. The more interactive this is, the more valuable it's going to be for all of you. And I'm sure if you have a question, other people have the same question. So you're doing a service to everybody that's tuning in. As usual, our presenter today is Garrett Zdolshek, who is the portfolio manager at IDR. IDR runs a series of index funds, one for the institutional market and the other for the private wealth advisory market for the individual high net worth accredited investor mass affluent marketplace. And all he focuses on right now is ODCE funds and their performance. And so he's got a vested interest in really digging deep. And he's kind enough to share his insights that he and his team have teased out of the numbers over the years. And we're going to cover a lot of different issues. So stay tuned. I think you're going to enjoy the webinar if you're a first timer. And if you've been with us before, you know what to expect. So without further ado, let me introduce Garrett Zdolshek. Garrett?
Jeff, hey, thanks for having me as always. Looking forward to this conversation today. The title, I think we always try to think of, something that piques our interest for the quarter. So today, the title is Uncertainty or Opportunity. We're ending the year with a lot of momentum. I think a lot of positive news coming out of 2024, and then tariffs happened in the first quarter. So we'll certainly talk about that. We'll talk about the impact. Are we seeing an impact yet in the first quarter or not? And then kind of what we're thinking through the remainder of the year. So without further ado, maybe I'll jump into the slides and the presentation and share my screen here. As usual, the agenda, we did add one other topic. So we're going to start with the NCREIF updated reporting. So we'll talk a little about the transition and the new property type classifications. And then the three topics we typically cover: the ODCE update, market overview, dig into fundamentals, what's happening, on the ground, and then finally capital flows, queues, sales, acquisitions, property types, etc. So As we look at NCREIF for 1Q, the top line numbers really remain largely unchanged. Number of assets are in these arrows are for the past year, change from 12 months ago. So some selling as obviously asset sales to fund redemptions. Occupancy is basically unchanged. Number of funds is unchanged. And leverage is starting to tick down finally. This is the second quarter that leverage has ticked down slightly. So that's again a positive sign with the stabilizing market and again, in our view, a recovering market. Property type, I mentioned that NCREIF reclassified subtypes and what subtypes sit in these main categories. So we'll cover that next. But you can see industrial up 2%, apartment fairly flat, along with retail, the new self-storage, and then other is down, if you will, because self-storage used to be another, and we'll talk about that in a minute. But I think most importantly, we think industrial is probably a little high with all the new classifications that may level out, I think, next quarter as reporting. There's a lot of mechanics around the reporting this time for the first quarter. I think that'll stabilize a little bit and show industrial coming down a little bit next quarter. Geographically, pretty flat, still an overweight to the west, the bigger markets, and the rest has been largely unchanged. For the subtypes, and again, this is the new NCREIF categories, and then they added a number of subtypes below those categories. So you can see self-storage has been broken out from other. You can see the new subtypes that are now considered other. And then a number of those have been moved into the major sectors. So, for example, within apartment, within residential now, you have manufactured housing, single family housing, and apartment is its category on its own. Again, same thing for industrial. You now have specialized, and then life science is a big question we get. Why is life science under industrial as well as office? And that's because life science does have some lab type space or manufacturing type space. So if it is more of a manufacturing orientation, it would go under industrial. If it's office or lab, it usually goes into office. In terms of the continued transition of property type weightings, I mentioned industrial in the top right. You can see that ticked up a lot this past quarter. I think that may be a little more flat going forward. Continue to see the office decline in terms of exposure. So I think, overall, the sectors are starting to level out a bit. And with these new classifications, again, this is based on all the new classifications, and we rolled it backwards. So you got an apples to apples view.
Garrett, I don't know what's happening, but you're fading out. Your sound is fading out.
Sorry about that. Is that better? Is that better, Jeff?
You have to speak for us to know that.
Is the sound better now?
Yes, now it's clear. Thank you.
All right. Awesome. So in terms of change, there's been a lot of change over the last few years. Industrial is up close to maybe 20%, residential up a few points. The big decline, certainly in office, down almost 18, a little over 18%. And then retail certainly is down from its peaks, but retail has been in a value decline, I think, before the other property types started. So talk more about that in the impeding recovery we're seeing in retail as well. So let me switch over to more of the performance side, and we'll start big picture, and we'll continually drill down into subtypes and performance of the asset class. Overall, though, from an asset allocation point of view, We certainly saw a decline in a bit of a drawdown in the public markets with the announcement of tariffs earlier this year. You can see that little V in the S&P 500. At the same time, while we're not at necessarily back to complete peak, uh, stock market pricing, we are, from a value standpoint in terms of a diversified portfolio, equities continue to become a bigger part of the portfolio if rebalancing doesn't take place. And again, I think this is positive for things like real estate as we just beginning that recovery. You can see that the denominator effect is largely controllable, and we're, again, for really the first time in a long time here, and many investors are now underweight real estate on the institutional side in terms of their asset allocations. And we continue to see, availability of liquidity coming back to the market in a fairly meaningful way in some cases. So for NCREIF and ODCE specifically, we talk about performance inflection points and seeing that 1 year returns tick positive again. That's typically when, in these past cycles, when the 1 year return has become positive, it stays positive. So we saw that here in the first quarter. The trailing 1 year return is now a positive total return. And that's typically been a turning point in the market to say, values have stabilized, and they are starting to either be more flat or start to rise in some cases. And we're seeing that across the board. From a overall return standpoint, first quarter net total return was 0.85%. And I think that's important more so from a appreciation standpoint. Appreciation was slightly positive overall. We saw that across sectors, and we'll drill into that more. But as we saw value stabilize on a trailing basis, that's also brought up the historical trailing 1 year return, which is now 1.2%.
There's a question that came in from an anonymous attendee. How many of the ODCE funds are not providing tender offers or redemptions? Or is everybody still pretty much working on getting their redemption requests satisfied?
So, and we'll dive into this in detail in terms of redemptions and liquidity at the underlying ODCE funds, but in kind of at a high level, I think of kind of three buckets. They don't have any redemption queues. There's a couple today that don't have any redemption queue. Majority still do, and then it's whether they're paying and how much they're paying. So we'll go through that in detail. In terms of kind of where we are in the drawdown and in the cycle, you can see from a peak to trough drawdown, the 90s, the GFC, and kind of where we are today, we're somewhere in the middle in terms of severity of the drawdown. It certainly hasn't, the value decline hasn't been as fast as the GFC. Probably, as we think back, financial markets weren't in a free fall. You saw the equity markets are still quite good compared to what we saw in the GFC. So, I think it makes sense that we're kind of in the middle in terms of the severity of those drawdowns. And then on the recovery side, it's looking a lot more like the 90s than the GFC, again, because I think the severity of the drawdown, the unknown, wasn't nearly as steep or impactful. But if you think about the 90s and the recovery kind of going back to the total returns here, it was a really long, sustained recovery. So it wasn't, the returns weren't quite as high as coming out of the GFC, but they were long sustained total returns. And again, I think we're kind of on that path of a little more consistent total return going forward.
Garrett, let me interrupt for a second. At our board meetings and other places where we're talking to people, we hear a lot of people talking about how the sentiment towards real estate and real estate capital commitments was improving, moving into Liberation Day, and then it kind of ground to a halt again. How has Liberation Day impacted Odyssey? And do we expect the recovery story to recover, to continue? Or did it stop also with Odyssey? Or with Liberation Day?
Yeah, that's a great question. And I think, well, first of all, we probably don't see the full impact of Liberation Day on these values through 1Q, given that it came halfway through the quarter or so. It's a slow moving market and valuation environment. I would say I'm not sure that we've necessarily seen the full impact. Markets certainly don't like uncertainty. That we know. And I think the equity markets responded for a bit of time and are now recovering again. And it was a pause to kind of in the equity markets to take take stock of what has happened. It's if you believe the public markets, they're not all that bothered anymore, right? Because they're going back to positive total returns here. REITs have been a little flat, but again, they haven't really reacted all that strongly to Liberation Day. I learned a new term yesterday, actually. It's called the taco trade. Uh, and again, this isn't political, but it's kind of meant to say Trump always chickens out, and that you can't just react to news day by day. You got to let it play out for a longer period of time. And that's certainly what the equity markets are doing. So I don't see a lot of negative return coming in 2Q or 3Q performance numbers so far. But I think that's going to drag out the recovery a little bit potentially as well.
Some people, I mean, just listening to people talking, you know, opinions are kind of like belly buttons. Everybody has one. But we're hearing a lot of people claiming, not a lot, but we're hearing enough people claiming that there seems to be some dissension over this issue of having hit bottom. I've heard people say that there's still quite a bit to go before we hit rock bottom on valuations, and that people are just being delusional if they think that we're past that point. How do you react to that?
I think that's fortune telling. Candidly, the private market real estate as a whole, measured by Odyssey, has revalued by 25%. Peak to trough value decline is 25% lower. I think if you look across real estate as a whole and think about maybe lower quality assets or assets and structures that are kind of extending and pretending, they're absolutely right too. There's a lot of that in the market. So I think it's a really bifurcated market. I think that high quality assets are poised to do really well over the next couple of years because construction is all but, new development is all but stopped. With inflation and the cost of new assets, to develop today. There's very little new supply coming on. So if I'm owning a really good asset, and we'll even show this in the retail sector in a minute. If I own a really good asset today, I feel really good about its competitive position over the next couple of years. I'm probably owning that asset 25, 35% below the cost to build that today. And that's massively competitive in today's market. So I think it's a long way of saying, Jeff, we could point at a specific building and improve that theory or disprove it very quickly. But if
And what you're saying is there's no evidence to suggest that it has a long ways to go, but there's concern among some people that it hasn't hit bottom.
yeah, well, look, I think if you're in an over levered asset today too, that's the other kind of point I think we have to make is if you're in a capital structure from a couple years ago that borrowed at 2%, 75% LTV, you probably have a problem today. And it's a much different outcome than if you're 25% levered with fixed rate debt that has only gone up 25 or 30 basis points over the last couple of years because you were fixed. So I think it really depends on what the strategy was, what you owned. If you're trying to lease up today, I think it's a little more challenging than it was a few years ago. Too, there's been more supply in apartments in the Sun Belt. There's been more industrial supply in the Inland Empire, built up over the last few years because of how in demand those assets and markets were. If
Now,
you're leased today, though, you're cash flowing a pretty good number.
somebody's asking, what about comparisons to fixed income and borrowing costs? Cap rates still don't cover the cost of debt.
So yeah, and we'll cover the debt market in a moment here, but I think again it looks a couple things. The reason I think the markets were opening up at the end of last year and pre-Liberation Day were buyers and sellers were coalescing around the view that interest rates would start to moderate a bit. I'm not saying they were going down massively, but they were going to moderate a bit. The 10-year was on a nice trajectory to, be around 4. And buyers and sellers were coming to that view together and that values based on that outcome. There was a lot of transaction volume. I think tariffs and Liberation Day put some questions back into the market about if that was true, would that happen, and how fast will that happen? And so that's where, some of this question is coming from. I think you're also looking at saying, I'm buying a new asset today at today's, cost of borrowing. That is true. But if you look at ODCE managers in the underlying funds today, their cap rates are actually higher than their cost of debt because they had a long-term fixed rate debt in place for this very reason to ride out these, rising rate environments. And they've largely done that, arguably, and they are not nearly as affected by rising rates as others are.
Okay.
So kind of maybe Jeff, coming back to kind of that value recovery concept and where are we in the market? Again, this slide is showing the top performing ODCE fund, the bottom performing ODCE fund, and then ODCE in each quarterly time period. So not the same fund every quarter, obviously, in the top or the bottom. It's just trying to show you where each quarter the range can be. And again, I think what I'm more encouraged by is seeing some of that spread decrease between the top and bottom. That's where we really see, again, more moderation or more view of where pricing is today and what it should be. There's always a timing difference, between some, views on performance, but as you go over time, you certainly see that getting closer together. The other way to think about this and look at this is the spread, whether it be from a property type or a fund, the difference between the best and worst performer. Each of these lines is showing you that. So you can see in the GFC, the fund performance had a huge spike in difference in performance spread, but the blue line, the property type spread remained pretty low, even though you had all this volatility. It's a completely different story to this past cycle where the blue line, the property type spread is actually even higher than the underlying fund performance spread. But in both cases, that is coming down pretty significantly here into 2025, which again, I think shows the coalescing around valuations and consistency around those valuation views. So over the last year and quarter, I mentioned this is looking at, and this is under the new NCREIF configuration, but this is looking at the gross unlevered value change of the property type. So again, no impact to leverage. And if you look across the board, positive quarterly or positive 1 year returns except for office. And even office is moderating pretty significantly over the last quarter, given the peak to trough is now about 45% value change. And that's unlevered, right? So again, if you were 65, 75% LTV going into this cycle and your office values are down 45%, that's a much different outcome than if you're low levered or no leverage on an asset. You're riding out this kind of period of volatility. In terms of just flat value change, so this is just looking at number of assets that had an increase in value, basically a flat, no change in value, or a decline in value. Again, we continue to see that recovery, take shape, and that values, are finding a bottom. Obviously, not every asset every quarter, but the vast majority now of assets are flat to slightly positive return, and the number of write-downs, it continues to decrease. And again, I think that's the facts point to that value stabilization and or recovery. Lastly, again, this is to reconstitute the new weightings in ODCE. But again, you can see that from a total return standpoint, so this includes income this time, total return standpoint, all sectors were positive total return for the quarter. And we haven't seen that, for a while, obviously, with the big office drawdowns. But again, 2 quarters positive total returns. I think it's another fact about where we are in the cycle and where we are with the state value recovery.
Okay, question coming in. Any color on data centers within ODCE? When are ODCE funds going to increase their allocation to data centers? And he adds, I believe some have separate data center funds.
Yeah, I think, many managers, there's a lot of data centers. I'm going to cover that in 2 slides where I cover all performance of the non-traditional sector. So I'll get to that in 1 second.
And then there's another question. What's going on in the single family home space? Are we seeing net positive flows or negative?
I'll hit that one too in 2 slides here. Here's a tile chart of the major sectors, and then the next slide will cover the subtypes and the performance of those subtypes. In terms of the tile chart, and you can look at this for a while and see a lot of different things, but the big takeaways I had from this chart were, 1, retail continues to be one of the top performing, if not the top performing sector. First time in a long time, obviously, for retail, but the value decline early is catching up and the income yields are attractive. 2, you can see office was the bottom performing sector this entire time, except until 1Q, when other is now the underperformer. And that's why we'll talk about subtypes and these other categories in a second. But thirdly, I would say, notice the ODCE, the black tile, is actually right in the middle again. So again, the weightings of what's outperforming and pulling things up versus pulling things down is becoming more neutral as well. Okay, so I promised to talk about the subtypes, and first question was data centers. If you look at the alternative subtypes, data center, there is some data center in ODCE today, and it's starting to build. The performance, though, data centers are the best performing subtype in ODCE, and I would say arguably the best performing sector for for a little while now. The challenge with data centers is it is largely a development program. So, and they're really big, right? So you had limited capital for really big assets that need to be developed. That's not necessarily always a great fit for ODCE funds in particular that want core stabilized properties. They tend to want smaller exposures to development and or really big assets anymore. So I think to the other point, many managers have created or are creating or accessing data centers now in specific vehicles. But in many cases, some of their ODCE funds are participating in those deals to kind of manage the exposure, manage the development, those kind of things. I think we're going to continue to see data centers perform really well, partly because of the development component, partly because, the demand for data centers. And I think thirdly, they have great tenant bases, right? They have really high quality credit tenants. So this doesn't surprise me at all. Notice the next one. I know we asked about single family, but notice the next best performer is the manufactured housing sector. I think again, it's a small but growing place, and that will be a pretty strong performer for a while. Finally, if you look farther to the right, we were asked about single family residential, quite a strong return. Seeing more and more of that, especially especially purpose-built single family communities. We don't see much, if at all, the single, kind of single homes, in all multiple locations. That seems to be much more specialized operating companies. But we do see more and more purpose-built single family communities in ODCE, and I think that's another really strong growing sector.
Okay, another question coming in. How do you expect total return mix of income versus appreciation to evolve through the next cycle? And what does that portend for total return expectations moving forward?
So I think this comes back to that NOI question as well, in terms of that total return. If you look back, about 70% of historical returns are current income. If you look at cap rates today, and Jeff, I may hit this in fundamentals, but if you look at cap rates today, it's also about NOI growth, right? So I think by sector it matters, and I think by geography it matters. But when we look at cap rates, the going in cap rate of 4.7% is much higher than it's been in a while. And you layer on a couple percent of NOI growth a year, that's pretty strong return, right? And
Can we go back one slide?
yeah,
Because there's some questions that we didn't address before we dive into this particular one. First question is, where is senior housing in this analysis? And the second is very similar. I don't see senior housing on this chart on this page 18, but keep hearing positive things about it on a go-forward basis. Is there just too little of it in ODCE funds to include here? Why isn't it being represented here on this chart?
That's a great question. Uh, the masking won't allow it to be on here right now. There's just too little of it in the index. So I think there is some interesting momentum around senior. It depends what level and what specifically type of senior. Again, it can be a lot of a big operating business. So I don't necessarily think we're going to see a ton of senior housing in Odyssey, but probably will grow a bit over time.
Yeah, there are a number of student or senior housing fund oriented investments that are not part of Odyssey.
Yeah.
Yeah.
Yeah, agreed. I'll just point out maybe too, in the not like as much we talk about senior housing, we talk about SFR or whatever, but by definition, not every alternative subtype is just outperforming or performing positively. In particular, life science continues to be, a challenge and a drag on performance. And I think we probably expect that to continue. You can see, especially the office life science and then even the industrial life science are both negative returns. And really only traditional office is worse. And again, I think there's a big reaction to all alternatives are great coming out of COVID, and that hasn't necessarily turned out to be the case. So Jeff, I promised we'd hit fundamentals and we'd hit, some of these valuation, NOI, current income topics. Maybe we start at the big picture and we'll drill down into some of those other cap rate questions in a second here.
Okay, just anecdotally, just as an aside, just doing a real quick search on IREIQ, 78 different funds um, include student housing in their strategies. And of those, many are open-ended funds. They're just not Odyssey funds.
I suppose, yeah. Yeah, I don't think it's a bad sector to be clear. I just it's not again, I think it's a more specialized sector that takes a lot of expertise.
Yeah.
So mentioned inflation, cap rates, interest rates. The Fed is certainly focused on two key points. One is inflation and one is unemployment rates. So as we look at inflation, again, I think this is why pre-tariff, the market was pretty confident on where things were going, given the trend and the trajectory of CPI. And it didn't really matter how you looked at CPI, core or total, but they were both trending down. They were both, well on their way towards that 2% mark. And unemployment was relatively steady, although starting to just like tick up and inch up a little bit, which again, I think was a positive sign for the market that employment constraints were easing a bit and not driving inflation as heavily as it was. So, overall, the data again would suggest we're in a pretty good spot. Well, I think tomorrow is the next Fed meeting. I think the consensus is it'll be unchanged, and there's still kind of hope for two cuts for the remainder of the year, and we'll see how that plays out.
Now, there's another question that really refers to the prior slide, but it says
Sure.
mall appreciation is surprising given some level of manager sensitivity to deal size. Is that being driven more by by an income basis?
So Jeff, to your question and point, if you look at the slide, retail and in particular mall is the third best performing sector at 11% here. It is not, malls are not an 11% cap rate, obviously, being a little tongue in cheek. You know, I think again, this gets at that broader point around the market, lack of new construction, good quality assets that are taken care of, that have low leverage, that weather the storm, come out the other side in a better place. There's a lot less competition, right? If we think about even our market in Cleveland here, there's less malls. And a couple have been torn down. One's now an Amazon distribution center. There's less competition for the dominant mall in a market or dominant two malls in a market. If you own one of those, it's been doing pretty well lately. And I think you're pretty happy with that cash flow and the operating performance. Now, I don't think they're going to be valued at three caps again, nor probably should any real estate.
There's another question coming in. The public and private cap rate spread for industrial and apartments remains quite wide. Moreover, industrial appraisal cap rates are lower than the 10-year, and apartments are at the risk-free rate. Surely further valuation decline should be expected, says the individual.
So let's go to cap rates. We so two things, I think. And to get to cap rates, why don't we just talk about Fed rate and the 10-year? The 10-year has certainly been bouncing around a lot. It was close to 4, it was close to 5 or hit 5. The Fed funds rate obviously is more stable. It is slightly below cap rates today, and it's really the first time it's below cap rates in a while. So again, I think starting to see the early signs of that dynamic moderating or changing a bit, maybe. And then let's go to cap rates. So I think you got to look at cap rates and remember, are we apples to apples? The public markets certainly look at cap rates differently than the private markets, and there's a couple opposing forces here. So the first is, I think, let's start with industrial at a 3.9 cap. It's up from almost 3. And it's largely up because of lease mark to market. If you signed a lease 5 years ago and are coming up on a new lease, even though the market's softened a little bit, you're definitely going to be raising rents from 5 years ago pretty significantly, and somewhere in that 30% range. So NOIs in apartments have certainly come down a bit and trended, down into the high single digits, I believe. They're still very strong, and there's still a lot of embedded NOI increase in the industrial market. Now, again, you can always point to, but I'm not going to go buy a 3.9% industrial asset, and that's fine. But if you're the owner and that own that 3.9 industrial asset and you have, your lease is coming up in a year, you're either not going to sell it or you're going to roll it, 30% higher rents and still sell at, a quote unquote market number. So again, I don't think you can just look at that cap rate on face value and say, like, I can't go buy that or it's too cheap in the market, because that's not the exact analysis being done.
Now, Brian Murdy has a question. With the slowdown in new apartment construction, are you starting to see ODCE managers committing to development again as part of their non-core allocations? Or is it not started yet?
Yeah, so almost any development in ODCE today is data center, apartment, or industrial. And so I think that will certainly continue. We are hearing more and more that I think industrial is starting to come back and look attractive again. I think that is also a conversation around cost of debt and interest rates as well. So yeah, I think, I'm not overly, and this is why I am bullish again on returns and values. The oversupply in apartment and industrial, I think, is going to be very short-lived. It's going to be a point in time. So if you own assets over the next few years that are in the market, I think you'll be pretty happy. And I think it'll show that demand for more assets and development is there, and that'll pick up in the next 12 to 24 months. But yeah, absolutely hearing about it again, a bit.
So the answer is yes.
Yeah.
Yeah, okay. And Eric Magendale has a question. Is there a chart or data that tracks the current at market cap rates for property type and overall Odyssey?
I'm not sure I know what that
I think
means.
he's saying transactional, right?
Oh yeah, yeah, that's a great point. There in Odyssey or NCREIF does release this. Uh there is a tracking of cap rates for market comps in terms of what's bought and sold at market. What I would say though is it is a thin data set. I think the last I looked, like in apartments, it was, a handful of assets per quarter. So you got to be a little careful with the kind of the data set or what's really within those numbers. Lastly, maybe I'll just kind of hit historically, we have been in a declining cap rate market for a long time. And the recoveries are typically spurred by a lowering of cost of debt. And so, I think we do need to show and point to declining interest rates have typically driven that, equilibrium in cap rates, or at least the cap rate expansion stopping, if you will. And I don't necessarily think that that's different here, in that the moderating of or outlook of interest rates is kind of moderating the outlook on cap rates. NOI is the other big, and we're going a little slow here today with the questions, which have been great, but I want to get to the Q's and everything. So I'll just point out here, for the first time in a while, Odyssey NOI growth is below inflation. If you think about inflation, a lot of it's driven by housing costs, either single family and apartment. So
You're fading out again on sound, Eric.
sorry about, not sure why, Jeff. I just think that, again, the early signs of moderating NOI growth in apartments are, again, a positive sign for moderating inflation. And lastly, maybe I'll hit debt maturities. Again, just within Odyssey at least, 27% LTV, very little roll over the next few years. If everything rolls at current market rates for the next 4 years, cost of debt for Odyssey funds only goes up about 50 basis points. So again, it's a very manageable roll of what needs to be refinanced and at what rate, which may or may not be very different from other comparisons or circumstances.
Well, we keep hearing about the wall of maturity, but it clearly isn't reflected in the Odyssey funds, which tend to have lower LTV and lower utilization of leverage overall to begin with.
Absolutely. So maybe we'll jump into the last section is capital flows. Asset level wise, in terms of acquisitions and dispositions, certainly a lot more dispositions than acquisitions, as has been the case for a while. I think the only big point here, though, might be the dispositions did slow down again in the first quarter after some consistent increases. And if you go back even farther, we were seeing some positive signs of increasing dispositions, which would tell you buyers and sellers are meeting, in the middle on valuations at least. I think with tariffs, we did hear about a lot of things getting pushed or delayed or uncertainty around closings. And I think that will probably continue into the second quarter a bit. So probably a little more moderating on dispositions here for the first half of the year.
question comes in, what is the composition of dispositions by property type? I believe that's on the next slide, is it not?
It is.
There we go.
So lots of residential, industrial, but almost a third office. So again, seeing that meeting in the middle between selling and buying, typically we are seeing, like when a disposition happens, it's typically right around NAV. But if you look 2 or 3 quarters earlier, the NAV was largely adjusting to where that disposition was going to take place. So again, I think this just shows that valuations are coming in line where you can transact. As we saw more dispositions, we are seeing more office dispositions. And again, I think that just the data continues to point to, valuations coming in line.
And do these pie charts reflect dollar volume or do they reflect number of transactions?
This is dollar volume.
Okay.
So when we think about Qs, cash flows, Qs are not cash flows, right? This is showing the net cash flow of all the ODCE funds in terms of cash that actually went in and was either committed and drawn or cash that was reinvested through reinvestment programs, et cetera. So the blue line, you can see in 23, early 24 was very, very close to zero, maybe $1 billion, which is largely just reinvestment of cash flow. You can see also how that started to pick up here in the first quarter, which I think will be evidenced by the Qs as well. So capital was starting to be invested again in underlying funds. This doesn't include secondaries either. Secondary market was quite robust, especially into the end of last year. So there's a lot more capital moving into funds and liking the valuations at year end than previous few years.
Now, there was a question also, what is causing all the disposition? Fund redemptions? And I think you already answered that, didn't you say it was fund redemptions?
Yeah, absolutely. And along with the fund redemptions and needing to pay out redemptions, I think given the market cycle and performance, there's a lot of rebalancing of the portfolios as well. So it's not just sell anything to pay, but also sell to rebalance for the future and performance going forward. And again, so coming back to kind of net flows, the black line is showing that there were more outflows than inflows. But again, you can see the gray, the distributions picked up as well. So a lot more cash flow moving, which again, I just think this shows you the market was opening up. Oh, sorry, let me get.
So how many ODCE funds are not providing redemptions? I think that was asked before.
Yeah, I'll come back to that in a second here.
Okay.
With an exact number, Jeff.
Okay.
Let me hit Qs first though.
Yeah, go ahead.
The total Q. So we've historically shown these Q numbers in terms of the GFC where the peak in 08, 09 on the red line compared to today's peak, but I wanted to kind of show the total history here to give a little more perspective. In the GFC, redemption Qs peaked at about 15% of ODCE NAV. In this most recent cycle, they peaked around 19%, so about 4% higher, and pretty much in line, I would argue, with what the GFC looked like. Now, dollar volume is certainly higher this time around than the GFC because the funds are a lot bigger than the GFC, right? So dollars are much different, but as a percentage, it looks pretty similar. I've also talked about how as that redemption queues come down, we've seen the entrance queues build up pretty quickly coming out of the GFC. We are certainly seeing the redemption queues come down at a pretty similar rate to the GFC, but notice the entrance queue actually dip down a bit. In our view, that's again a positive sign because what it's telling us is commitments made to underlying funds are actually being drawn by those underlying funds. They're finding places to use the capital. They're finding interesting deals, and they believe returns, are going to be positive going forward. Otherwise, they wouldn't probably want to draw too much capital from new investors. So again, I think you can see it's slightly moderated here in the first quarter, but overall that line is coming down pretty quick. So one fund did not pay any redemption last quarter. Over the last year, all funds paid something at some point over the year or so.
And how many funds again did you say have no queue?
So I believe 3 funds have no exit queue anymore, and that's pretty recent.
And here's another question. To what degree are queues reducing because of distributions versus rescissions versus secondary market transactions?
So I don't know if I can necessarily break out all those pieces, but I can give you the direction of all those pieces. And this chart's a little confusing at first. Investor impact represents new redemption requests or rescissions. So if it's above the line means there have been new redemption requests in the quarter. If it goes below the line, it's being impacted by rescissions and NAV decline. So you want to see that light blue line below zero, meaning the queues are getting smaller because investors are rescinding and not putting in much redemption. Now notice in one queue here, we saw more redemptions come in, probably because of tariffs and the reaction to tariffs, in our view, after 2 quarters of some positive progress in terms of more rescissions than new redemptions.
And somebody asked, what is the outstanding redemption queue in the prior page as of Q1 25? 13%?
Yeah, 12.5% basically today.
Okay.
So over the last 5 quarters, basically 15 billion of redemptions have been paid. In the last quarter, about 3.5 billion of redemptions were paid. I think what gets lost in that net Q number is the fact that new redemptions can come in every quarter as well and kind of impact, the progress you're making on redemptions, right? In other words, if you look at kind of the net effect, you can see at least over the last 4 quarters, the redemption queues have been coming down, but in some cases there's new redemptions coming in as well that doesn't make it quite as steep or as fast as we'd like.
Yeah, we have heard too that the hot spots of the market right now are private credit and infrastructure, with a big nod toward infrastructure. And we've also heard at some of our board meetings, investors say that their CIOs are decreasing their allocations to real estate in favor of infrastructure within the real asset portfolio. So that might have an impact as well.
Yeah, I mean, and if you look at historical returns over the last few years, there's been better returns in other places, and investors tend to look backwards on performance sometimes, right? So I would say, yeah, that's where the better performance has been historically. We'll see about going forward, given where valuations are. But the last point I'll just make is in terms of redemptions paid, the percentage of the Q paid, it continues to get better. And really over the last 2 quarters, it's been about 12% of NAV. So again, I think making some progress. Liquidity is certainly coming back, but not nearly, I think what everyone necessarily wants, which is perfect liquidity, right? If you're in the queue, you want it tomorrow. And I think, again, that kind of impacted the secondary market, and that we thought we were going to get capital back maybe a little faster pre-tariff than we do now. So certainly seeing some more secondary market build up again.
Now, there's another final question. Going back to contribution queues, how much is due to funds drawing on capital to deploy in the market versus investors canceling unfunded commitments?
I think there's very little canceling of unfunded commitments. I think the majority of new commitment is I would say probably half actually is going to new deals, and half is probably going to pay down redemptions. That seems to be like a good equilibrium for everyone.
Okay. Well, listen, normally we open the mic up for more questions, but we're right up on the hour and we want to be sensitive to people's time commitments. Thank you, Garrett, for you and your team and all the work you do in preparing and putting forth this information. Really helpful, I think, for the whole industry. And thank all of you for tuning in and being part of this. We really appreciate your interest in the work that we're doing. See you all next time for the second quarter update, which will be coming in a few months. Thanks so much, everybody. Have a great summer.
Thanks, Jeff.